Well, good morning, everyone. Thank you for joining us for today's discussion. My name is Hunter Pierpont, and I'm the Vice President of Education and University Outreach for the local CFA Society Atlanta. Welcome to our online series. Today's topic is enhancing valuation analysis through customer-based corporate valuation. Some of our upcoming events in the month of May are an online series focusing on NFTs, fad or frontier asset, dispatches from the metaverse, a online series on Crypto 101, intro to blockchain, Bitcoin, and crypto. And finally, at the end of May, we have a live in-person event at BlackRock, which will be a member community investment strategy roundtable. So we are hopeful that you can join us for those events. They are on our website at cfaatlanta.org. We are joined today very graciously by two members of Emory, Daniel McCarthy, Assistant Professor of Marketing at Emory's Business School, Goizueta, and Tammy Long, the Open Enrollment Director in the Executive Education Department for the Goizueta School of Business. Please submit any questions you have via the Q&A feature within the Zoom controls at the bottom of your screen throughout the presentation, and Professor McCarthy will review them. And with that, I will turn it over to you, Tammy and Dan, and thank you so much for joining us today.
Thank you.
Yeah, thanks so much for having us, and you're really excited to dive in. Just wanted to say at the start, please do send those questions through. More than happy to take them throughout the talk. So this is definitely not something that I would hope to be a monologue. Yeah, happy to answer questions as they come up, and yeah, really, really excited to dive in. So I think what I'm going to do now is I'm just going to share my screen. All right, so hopefully everyone can see it. Yes, as Hunter had said, what I'm going to be talking about today is how we can leverage consumer behavior to enhance our ability to predict revenue and to use models for customer acquisition, retention, ordering, and spend to better understand the unit economic health of businesses. So yeah, I think that it's an area that's becoming more and more popular, but at the same time, there's still a lot of misunderstandings about how we can leverage these sorts of insights. So hopefully this talk will help you kind of understand how we can think about it more clearly. So why me? Well, for one, I'm, as Hunter had mentioned, I'm a marketing professor here at Emory University, Goizueta School of Business. I specialize in doing these methods. So my dissertation was all about customer-based corporate valuation, which I'm going to be talking about shortly, and how we can be able to estimate models for customer adoption, repeat purchase, and spend using the sort of data that public companies will often regularly disclose. And so this is not something that's hypothetical. It's not something that we need to have special NDAs in place with the companies that we're looking at. You can actually do this for a very large number of companies, and I have. So we'll go through a couple of examples over the course of the talk. I've also started a couple companies, which has given me perspective about these things. So I started a company called Zodiac, which was a predictive analytics, marketing analytics software as a service firm that I grew and sold to Nike in March of 2018. And we used the same sort of models that I'll be talking about today. We probably ran the numbers on 250 companies. So I've been able to develop a lot of perspective about these sort of models and when they work and when they don't over the course of those engagements. So as I mentioned, I sold it to Nike. We were able to carve out of the non-compete with them the ability to continue to pursue this topic of customer-based corporate valuation. So along with my co-founder, Peter Fader, we co-founded a second business called Theta, which does nothing but customer-based corporate valuation, often on behalf of private equity firms. But here it's more to better understand how we can kind of use these insights for understanding the health of businesses from a unit economic perspective. So again, exactly the sort of stuff that I'm going to be talking about today. So I really hope that this doesn't come off as being super theoretical ivory tower stuff. Obviously, this is grounded in academic work. I've written multiple award-winning academic papers about this, but we've also brought to life literally hundreds of times. So, so I really want to make sure this is something that's useful for you. So in terms of the agenda, I'm going to go through the high-level framework for CBCV. I'm going to be using that acronym a lot. So CBCV, again, is customer-based corporate valuation. I'm then going to talk through how it can help inform an understanding of unit economics. So this is, again, something that we see being discussed a lot more about companies. And so really understanding, like, what are best practices for the definitions of these metrics and how we can use them to inform our understanding of the potential at the businesses that we're looking at. That's the sort of thing that this could be helpful for. I'm going to bring it to life with a real world example, Blue Apron, and then talk through some of the issues that you might want to think about as you're applying this in the real world to public companies and using these insights on a regular basis. And then I want to put it back on you. So this could be a call to action at the end, just things that I would recommend that you do as you're kind of looking to leverage this sort of insight to do valuation better yourself. So if you were to open up pretty much any standard corporate valuation textbook, like the McKinsey valuation book or Oswald de Moderon's various valuation books, they're going to break down the value of a company's equity into three pieces: operating assets, non-operating assets, and net debt. And the most important, but the hardest to value, are those operating assets. This is everything about the ability of the company to generate revenue and have that revenue flow through into free cash flow. And there's a lot of things that drive the sort of moat that a company would have that that enables it to generate free cash flow now or into the future. But the thing that I would posit as a CBCV person is that underlying every dollar of revenue that a company is getting is a customer who's making a purchase. And so the sad part, the gap is, I'd been on the buy side for about 6 years before going back to get my PhD. And what I found was that people didn't really incorporate the customer into the process. Maybe, you might find someone who's doing scuttlebutt research and they're doing some survey work or something like that. But oftentimes, even if the transaction log of the company was given to the potential investor, the investor won't really know what to do with it. And the sad part is when you go to these corporate valuation textbooks and just look to the back of the book for the word customer, that word is typically not there, not in this sense. So this work is really meant to address that there is value to be had by incorporating this information that can be available through our understanding of customer repeat purchase behavior. So just to kind of bring it to life, imagine we're thinking about some company and we're looking out over the next 3 quarters. The first thing that we're going to do is we're going to model and forecast the flow of customers acquired over time, and then how long those customers stay after they're acquired, before they churn. And if I had a good model for customer acquisition and for how long those customers stay, that has to give me the size of the customer base for that firm for free. If I then knew how many purchases each of those customers are going to make, and then how much they spend on each of those purchases, then that has to give me revenue. So in some sense, I think of CBCV as a basic accounting identity, where we're kind of breaking down revenue by understanding where it came from in terms of customer adoption, retention, purchase frequency, and spend. Now, pretty much everything else in this sort of framework flows through, for the most part, as you would do in a traditional DCF-based type valuation. So, we have our variable costs and our fixed costs. We've got the costs spent to acquire customers, all the rest of the overhead. And then we make our working capital adjustments to understand how profitability translates into cash flow. And that drives free cash flow. And then we just kind of discount it back and we end up with our fair valuation estimate of the stock price. So again, the bulk of the value add for this framework stems from the upper slice of this table that we see over here. And the main thing that we need to bring it to life is we need 4 things. The first thing is we need a predictive model for the flow of customers acquired over time when they first adopt to the company. We need a second model for customer retention. So customers are acquired. Imagine that the x-axis is tenure or months since adoption. how many of those customers stay. The third predictive model that we need is for purchase frequency. How many purchases do each of those customers make? And then the fourth one that we need is for how they spend. Yes, is spend growing as a function of calendar time? How much variation is there in spend from customer to customer? If we have that sort of data, how might spend vary as a function of customer tenure? Those sorts of things. But if I had those four models, that will allow me to break down revenue and understand it better. And the great thing is, within the marketing science literature, we've actually spent a lot of time thinking about specifying these models in a very accurate way. And so, one way of thinking about CBCV is kind of taking these best-in-class marketing models that have primarily historically been used for, within the marketing department for kind of customer value segmentation purposes, and just bringing those together into a valuation model, by predicting revenue more accurately. So revenue prediction is one thing that we get from a CBCV model. But the other thing that we get, again, when we think back to those four processes over here, if we kind of ignored acquisition, just focused on the other ones, it gives us things like customer lifetime value for free. So there's customer lifetime value, there's how it breaks down into what I call post-acquisition value, and then there's customer acquisition cost. So those are three acronyms that I'll often use a lot: CLV, PAV, and CAC. What PAV represents is the net present value of all the future profits associated with the customer after acquisition. And CAC represents how much I spent to acquire the customer. And then if I take PAV and I subtract CAC, that is what gets me customer lifetime value. So let me just kind of provide an example. This was from an actual diligence, and these are the real numbers for the company that we were analyzing at the time. What it is the post-acquisition value, which we see in dark blue, and then the customer acquisition cost, which we see in the purple, and we see that by acquisition cohort. So take all the customers that were acquired in 2015, 2016, 2017, 2018, and get these numbers. And what we can see in this particular example is that post-acquisition value, or the value of a customer after acquisition, is fairly stable. Maybe it's slightly degrading over time, but in general, it's looking relatively stable and healthy. The acquisition cost, which we see in purple over here, has been hovering at around $40 for the past 4 years. And so the value of a customer is the difference between those two. So in 2018, if we're making 100 after acquisition, we're spending 40 to bring them in. That means on every customer, we're making about a $60 profit. So $60 would be the CLV. And so the CLV to CAC would represent the implied return on investment, or about 150%. And that's what we see in those little bubbles with the percentages up above the bars. And what this allows us to understand is there a path to profitability if the company is not profitable yet? And path to profitability is extremely important. You take all these companies that are growing really quickly, a lot of them may not have a path to profitability, but some of them will. And so especially when we move into settings like, pre-IPO these days, but growth private equity as well, you really want to know, is this a company that has a clear path to profitability or not? And the way a company has path to profitability is if it meets the following criteria. First, that it currently has a good CLV to CAC. In other words, the marginal profit that you get from that incremental acquired customer is sufficiently large relative to the amount that you spent to bring the customer in the first place. The second thing that you need is a sufficient amount of future customer acquisition. So I want very high return on investment for new customers I'm acquiring, but then I want to bring in enough of them to be able to hurdle over all of the fixed cost overhead that encumber that variable profit. And then the third thing that I need is that I want to make sure that the unit economics don't degrade in the future. So I need it to kind of stay at a reasonably good level. Now, obviously, there are other ways that you can have path to profitability. And what some people will argue is, well, maybe the firm does not have good current economics, but maybe the future steady state economics are going to be good. But then that's kind of one other if that you're going to need to be able to make that valuation case. So this is how we'll often kind of break the numbers down for companies that are going public these days, like Warby Parker. Now, there's a whole bunch of other measures besides CLV, post-acquisition value, and CAC that you're going to want to think about to the extent that you have the data to be able to estimate them. So one are finite horizon variants of those CLV and PAV figures that I mentioned. So traditionally, the CLV of a customer would be the net present value of all the future profits that you're going to get. It could be out, 5, 10, 15, 20 years. The trouble is, if we're going out that far, first, it's unlikely that we're going to be able to directly observe that. And so companies may want to include figures like this in their investor filings, but there's no way they could provide auditable figures for that, because typically, if you're going to pull together an investor prospectus, you can't include predictive measures in it. And so one of the convenient things about a finite horizon calculation is you can actually observe it. And because we're limiting ourselves to just the next 1 year, 3 years, 5 years, or some kind of shorter horizon, we can have more confidence in our prediction than in one that goes out 20 years, because, we don't necessarily know how the world's going to look 10 years from now. So we do see companies disclosing this sort of data. So here's a Farfetch. They're a luxury marketplace, and they're disclosing LTV to CAC. This is in their pre-IPO prospectus over the next 6, 12, and 24 months for various acquisition cohorts. So obviously, at the time of their pre-IPO prospectus, the 2017 cohort, they could only observe 6 months worth of data for them, whereas for the 2015 cohort, they observe over 2 years worth of data for them. That's why we see more dots for that black line than for the, I guess that's a beige. But in general, what this is conveying is unit economics are getting better over time, and they're getting better across acquisition cohorts, which is kind of nice to see. And then there's payback period. Yes, this is somewhat related, but what it represents is the cumulative time until contribution profit exceeds customer acquisition cost. So how long is it until I get my money back? If I spent that $40 that I saw for that previous company, how quickly do I get back to 40? And this is an important thing to know, because once you get your money back, you can redeploy that marketing customer acquisition budget to acquire new customers. You could have a company that has a really good implied marketing return on investment, but if it takes 3 years to get your money back, then you might need to raise more money to be able to fund future growth than if you got your money back very quickly. So a lot of companies that have good payback periods will disclose figures like that in their public filings. So here's Revolve Clothing. They're a kind of a higher end clothing company. I think that they're still e-commerce only. And what they're showing over here is their customer acquisition costs. That's the leftmost bar. And then we're seeing the contribution profit associated with the first order over the first year, the first 2 years, 3 years, and 4 years. And so one thing that they're highlighting, obviously they've got great economics, but one thing that they're highlighting over here is even on that very first order, they're spending 30 to acquire the customer, but then on the first order that births the customer, they're getting back $43 in contribution profit on average. And so they're getting their money back immediately. That's very nice to see. So there's just all sorts of metrics like this that we want to know. And you really want to know these numbers, especially if these are businesses that aren't necessarily profitable today. And so I think of it as a report card. And in the same way that for little Johnny, you're keeping track of math, English, and science, you want to have something on your report card for unit economics. And you want to know, is this company scoring an A, B, or C, or something else? And you want to hopefully be able to have these figures, not only for today, but the progression until today, with a view to what the economics are going to be in the future. So that's what this is all about. And one important thing is we need to calculate these figures correctly. Companies that put this sort of data in their public filings are often including them as marketing material. So there's this notion of what I call selective disclosure, that companies are not required to disclose any of this information. It's all voluntary. And so, again, what they're trying to do here is they're trying to market to potential investors. If a metric makes them look bad, they're not going to put it in, probably. If it makes them look good, well, then they might. So in general, that's why we're seeing the figures that we're seeing. But the other thing that companies will do is they'll define the measures in the most optimistic possible way. And so you really need to be careful and read through exactly what the definitions are, because there's no, in the same way that disclosure is voluntary, there's no hard set rule on the definitions of the disclosures. And so they can kind of game those. So again, we want to make sure that the report card is accurately gauging the measures that we're looking to study. Let's see if there's a question over here. Oh, yeah, that's just Kathy. So this is just to give a brief summary of the sort of things that we can see. So let's just think about customer acquisition cost. So as a starting point, what we'll often see is that CAC is defined to be sales and marketing expense divided by customers acquired, the total gross customers acquired. Now this, I'll be the first to say this is not the best definition. It's a good place to start, but it's not the best definition for a handful of reasons. For one, that sales and marketing expense is not only being spent to bring in new customers, it's also being spent to generate repeat orders from existing customers. And so one example of that is Wayfair. You know, they're the online furniture retailer. What you can see over here is they say that they assume about 7% of their ad spend is being spent on repeat revenue, not new customer acquisition, but on repeat revenue. And so when we're calculating our CAC, we want to not encumber it with all of that repeat ad spend. We want to take that out. But then the flip side is that we want to ding the contribution margin to account for all of that marketing money that needs to be spent to bring in the repeat orders. There's all sorts of cost allocation issues. So Warby Parker, they disclosed a whole bunch of great information in their pre-IPO prospectus. But one thing that they said was, when we're calculating our contribution profit, we're going to remove all of our store-related expenses. And the thing is, you know, Warby Parker, when they were first acquired, they had no stores. Now they do. And there's a lot of people who are acquiring into Warby Parker because of the stores. And so if stores are driving customer acquisition, then we want to include some portion of store expense in customer acquisition, because that money is being spent to acquire customers. There's lead lag issues. So in Toast, they're a software firm, and their pre-IPO prospectus, they define CAC. And one thing that they said was the money that they spend to acquire the customers at the time that they sign the contract, they're not going to start generating revenue until 3 months later. And so what they did in their filing was they defined CAC to be the marketing spend from 3 months ago relative to the customers acquired today, to account for the lag between contract signing and revenue, the time that revenue starts flowing, which is actually that seems reasonable to me. We can't really do this in some sort of a systematic way. When companies start adding things like lags, the natural inclination is going to be for them to have long lags, because that means they're going to be comparing marketing spend from a long time ago, which tends to be smaller relative to customers acquired today. So you can just imagine all sorts of games that they can play if they had that sort of latitude. But for individual companies, this actually can make some sense. There's also this notion of gross versus net CAC. And I kind of alluded to it in that Revolve example. Peloton is another company that directly disclosed, you know, what they called their net CAC. And all net CAC is their customer acquisition expense, but where we kind of remove the contribution profit from the first order. Because in businesses like Peloton's or in Revolve, to be acquired, you need to make that initial purchase. And so yes, you know, maybe I spent $800 in the case of Peloton to acquire the customer, but if I know that I'm going to get $800 back in contribution profit on the bike, then is my CAC 800 or is it 0? And so that's kind of that's the distinction. So this is, I think, a helpful view. And it's good to keep this in mind, but we want to keep these terms straight. So again, there's just all sorts of things like that. I guess one final one is, what is an acquisition? And so in the case of Toast, they did another funny thing. So they said, we're going to take, you know, our acquisition related expenses from 3 months ago and compare it to customers acquired. But they said customer acquisitions is equal to like the gross customers that they acquire plus every single customer that they upsold. So if you're an existing customer and they upsold you into a new product, then Toast is considering that customer to be a new customer. Seems a little fishy to me, you know, but that's, again, the sort of thing that they can do. I see all sorts of articles in the media where they kind of do the opposite. And instead, they'll define customer acquisition to be net customers acquired, net of the customers that churn. And that is a completely ridiculous calculation. So again, if you're a reporter, it bleeds, it leads. And so you'll oftentimes want to report figures that lead to very high CACs if you're writing an article, you know, that's bearish on direct to consumer. If you're one of the companies themselves, you basically do everything that you can to make CAC smaller. But again, the beauty is, if we know what it should be, what it should represent, then we should be able to uncover what the truth might be, you know, under a more correct definition. Now, I guess the final point I wanted to make is this may make it sound really complicated. Like, if it's really this hard to calculate CAC, then maybe I should just wait until I have the perfect definition. And I don't want that to, I don't want to imply that. Yeah, I think that in general, start with a reasonable definition that's not too bad, and then get better over time. You know, so start with that definition of acquisition related marketing spend divided by gross customers acquired. I think that having something that's somewhat correct is going to be a lot better than having nothing at all. Now, the big question is, all right, so that's CAC. How about post-acquisition value? Now, to get post-acquisition value, we need those predictive models. And you think, all right, so how am I going to specify models for customer repeat purchase and spend? There's two main distinctions that we need. It's not about B2B versus B2C. It's not domestic versus international. The two key dimensions that we need to keep in mind are the business setting. Is it a subscription business or a non-subscription business, or a hybrid of the two? And what sort of data do we have? Do we have rich internal transactional data, or do we just have aggregated data, the sort that we would find in SEC filings? So I'm going to unpack that 2 by 2. So again, first, subscription tends to be the easier of the two settings. It's more like shooting fish in a barrel. And there's a handful of reasons. The first is we directly get to observe when customers churn. Think about your cell phone subscription or your newspaper subscription or all those streaming services. You actually have to cancel your service or otherwise you're going to continue to pay. And while you're with the company, typically you're paying that same monthly fee every month. And so a lot of the uncertainty in post-acquisition value just stems purely from how long you're going to stay. So that tends to make the problem a lot easier. The problem is most businesses are not subscription businesses. Most are non-subscription. So again, this is going to be everything like retail, restaurants, gaming, travel, you know, hotels, et cetera, et cetera, et cetera. And the thing that makes it harder in this setting is, for one, if you think about, you know, that last place that you bought a shirt from, it's not like if you really didn't like the shirt and you decided, I'm never going to come back, that you like write them a letter and say, I am never going to purchase from you ever again. And honestly, even if you did that, you still might come back. You know, I mean, there's nothing contractually that's saying that you cannot make a purchase in the future. So, so they call that unobservable or latent attrition. And so we have to kind of infer attrition from the lack of purchasing. And that just makes it harder. But even while you're with the firm, even if I knew that you were alive, the number of orders that you place and the amount that you spend, it's going to be a lot more variable across the customers and over time. So during the holiday season, there's a lot of holiday buying. Other times of the year, there's not. Some people buy a ton, other people buy a little. And so we want a model that it kind of allows for all that. So it's harder, but the good thing is, as I mentioned earlier, within the marketing science literature, we spend a lot of time studying these sorts of models. We've got some really good ones that do a very good job, and they're actually easy enough to implement. And public, there's been packages that have been made available so that you can use these very easily without having to really code up anything. You can just kind of take these pre-existing R packages that people have written and just kind of use them out of the box. Next is the data. So if I could, I would love to have the most granular data possible. I would love to have the full transaction log for companies. And I've been surprised in private equity due diligence settings just how often we'll get the full transaction log and CRM data from a company. They'll just give us everything. So who did what, when, and how much did they spend? That's the sort of that we can get. And what this allows us to do is specify a much richer model than if we only had aggregated data. So this was basically the main data source for Zodiac. So we worked on behalf of marketing departments. We ran these sorts of models. We would compute charts like the one that you see over here. And oftentimes the charts look exactly like this. You have this breakdown of CLV. We're looking at all the customers in their customer base. And what we find is most of the customers suck. They're worth very little. And then there's this bar of customers on the right-hand side that's worth a heck of a lot. And so it's this barbell distribution. And we want to understand what is it that makes those two groups of customers different from each other, so we can acquire more of the best customers and fewer of the worst customers. Again, Nike is the one that bought our company. And this in and of itself was striking. 30 years ago, they wouldn't have even cared about us because they primarily sold through companies like Foot Locker. And while Foot Locker is a great distribution channel, Nike doesn't know what the end customers are purchasing. They just know how many sales they're getting from the Foot Locker or from various Foot Locker stores. But they've been making this big pivot towards direct to consumer, cutting out middlemen like Foot Locker, which got hammered recently when Nike had kind of made it known that they were going to decrease their sell-through through Foot Locker in the coming year and sell more through their website and through their own stores. And so companies like Zodiac can really help Nike monetize the direct customer data that they now have available to them. So again, we were able to carve out this non-compete where I said, no, we're not going to start Zodiac 2.0. We're going to leave that be, but we have the ability to pursue customer-based corporate valuations so that we can work with private equity firms. That's basically what we graciously were able to work out with Nike. And so at Theta, we more frequently will have aggregated data. So again, I've been surprised how frequently we have granular data, and it's wonderful. It allows us to do a whole lot of things like what we could see on that Zodiac slide and do that for every single acquisition cohort, for every single segmentable variable that we have in the CRM data. But there are a number of times where we only have external aggregated data. And this is more like the data that I was showing on that slide, the CAC slide, where they say, our CAC is X, or our payback period is Y, or LTV to CAC across these different acquisition cohorts is Z. And so we kind of have to do this thing where we kind of connect the dots based on the data that's available that we can find in SEC filings and investor presentations and work with that instead. So the only thing I wanted to call out here as well is another useful aggregated data source is credit card panel data. I think this is something that's being used more and more these days. Historically, it had only been used for the most part for nowcasting revenue, that we want to know what revenue is going to be in Q1 of 2022. Well, that's oftentimes not disclosed by the company until, late April or something. But we can actually observe Q1 revenue within the credit card panel like a week later, a week after the end of the quarter. And so they'll kind of use this data to do that. But what it can also be used for is unit economic analysis. And so that's, I think, something that we're starting to see more of, and I expect that trend to continue. So that's kind of an overview. Again, I cover these sorts of models in my class. So to the extent that you're interested, love to speak with you about how you can kind of train up the sort of models that I'm talking about. But I'm just going to go through one case study of Blue Apron. So
before you do that, Dan, we have one question in the chat. So which art packages do you recommend for these well-known marketing models?
Yeah, so the BTYD art package is one. That's where I would start. There's an analogous package that's available in Python. I think it's called the Lifetimes package in Python. So I'm just putting those names in the chat. My understanding is that the Lifetimes package is not currently being maintained. So it may be a little bit outdated. There's another package called CLV tools in R. So that could be another one to look into. And then the final one is called BTYD plus. So the BTYD R package, that has kind of the most like plain vanilla standard models. BTYD plus, for those who are feeling more enterprising and aggressive, it has what's called the Pareto GGG, which is a pretty cool model. And CLV tools has a suite of other models as well. So I would look into those three. But again, shoot me an email. Maybe what I'll do is I'll also put my email down over here if you'd like some additional information about those. You can also run these models on subscription businesses. And the great thing is these subscription models, you can actually do them in Excel. So I'd be happy to share some templates from that. So yes, if you have any questions, just please chime in. So now Blue Apron, they're basically a subscription business. And I was looking at them. I had actually just finished my PhD dissertation. It was about this stuff. When you have a hammer, everything looks like a nail. And it just so happened that Blue Apron, they filed their pre-IPO prospectus, their Form S1, shortly after I defended. And so I was like, why the heck not? I'm just going to take a look and see, can I run this framework on the Blue Apron data? And the interesting thing was, at the time, they were the market leader and they were growing very quickly. They had over 50% market share. The top two companies had over like 75% market share. It sounds like a duopoly. And they were growing year on year over 100%. So the story that they were telling at the time was, we're growing super quickly. We have a dominant market share. Most people are saying that the space is going to continue to grow very quickly for many years into the future. And we even had one quarter that we were profitable before. And so as long as we're able to hold on to a reasonable amount of that market share, we'll be able to grow our way into consistent profitability. And the nice thing was they provided a whole bunch of really cool customer level data. So the first thing that I did was train up the sort of model that I alluded to on that earlier slide on all the data that they had disclosed. So how many active customers do we have over time? The orange bars represent what they actually disclosed. The blue bars represent what I had inferred through the model. Cumulative customers acquired from, I believe, Q1 of 2014 through Q1 of 2017. And then cumulative net revenue per acquired customer by month since acquisition. They disclosed a whole bunch more data. And so it was really helpful in being able to identify the sort of model that I described. And that's kind of the game is we say, what are the parameters for the acquisition, retention, and spend models that give us expected data that's as consistent as possible with all of the actual observed data? That's basically what the parameter estimation procedure entails. So along all these different dimensions, the model fit really well. And it allowed us then to have confidence that we're capturing what's going on with customer retention and spend. And one thing that we could see when we then took the results from our retention model and just looked at the implied retention curve, it was really not good. So this is what we call a survival curve, a retention curve. And what it shows is the proportion of the cohort that's alive by the number of months since acquisition. So obviously you first acquire a cohort of customers in month 0, they're all acquired. So they're all retained. So you always have 100% retention in month 0. We see by month number 1, about 55% of the cohort had dropped out. And by month number 6, more than 70% of the customers had dropped out. So that's tough. It's tough to make money when you're losing that many customers that quickly. This is a chart of their CAC, of their customer acquisition cost. And this green bar, this green line represents the average post-acquisition value, the amount that they make after acquisition. So what you want is a nice big gap between the blue and the green. And what we can see is 2014, 2015, there was actually, a reasonable gap. That Blue Apron was spending, call it $50 to $60 to acquire customers. And then after acquisition, they were making back 133. So that's a nice, more than 2x of their money. But in that run up to the IPO, they were spending a lot more on marketing and they were acquiring more customers, but the rate of growth of marketing spend was more than the rate of growth of customer acquisition. Their CAC was just moving up a lot. and it actually started to bump up against their PAV. And you can't make any money when PAV is equal to CAC. So that's a problem. And so I put this silly analysis out there on LinkedIn. I put a lot of silly things on LinkedIn. So if you're interested in this sort of stuff, maybe one thing I'll do, I'll put my LinkedIn profile over here. I've done a number of analyses that I've put on LinkedIn. And it kind of broke the story about unit economic issues at Blue Apron. So it ended up being featured in pretty much every major media outlet, including the Wall Street Journal 3 or 4 or 5 times, but a variety of other outlets as well. I've written an HBR article on them. I've got an HBS case study on them. So I've spent a lot of time thinking about Blue Apron and meal kits in general. The stock price it's been rough sledding for them. So they originally were targeting an IPO price of $15 to $17. I put out the analysis a few weeks before the IPO. They ended up IPOing at 10. And right now they're at the equivalent of 25 cents. So they did a 15-for-1 stock split. So when you adjust for that, that's why you see a bigger number over here, 373. It's not that they IPO'd at 10 and they're currently at 373. It's that after you adjust for the stock split, they effectively IPO'd at 150 and they're at 373. So the stock is down significantly since the IPO, and for reasons that I think were predictable at the time. So I'm just going to very quickly go through some other things to watch for. One are misleading definitions. So I'd kind of talked through some of those issues with Toast with their CAC calculation before, their calculation. But Warby Parker had similar issues. They reported customer acquisition costs where they took customer acquisition spend and they divided it by the total number of active customers, whether or not you were new. So, I think as of the most recent year, most of their customers that were active were existing customers. They hadn't even been acquired. So how can you compute CAC where you're including all those existing customers in the denominator? The reason why you're doing it is to have a low CAC, but that's cheating. Cherry pick disclosures. So Allbirds disclosed basically nothing, but they did disclose that they're profitable within the initial month of purchase on 100% of all cohorts as of the time of the pre-IPO prospectus. So that's a really good thing. That implies that maybe they don't have first order profitability, but they have first month profitability across the cohorts. But it would have been helpful to have fleshed out that story a little bit more. Look to alternative data. It's out there and it's very, very useful. It's granular. You can do all sorts of really cool things. I have this one analysis, again, one that I put out on LinkedIn that uses it. But the thing that you want to watch for is that typically these credit card panels are only for US individuals, and it's for about 2 million, 3 million people. And so 2 million, 3 million, it's a big number, but it's not the entire US population. And for businesses that only sell, for businesses that sell primarily, say in cash, they won't see cash transactions. They'll only see credit card purchases. For B2B, then it tends to be tricky to use, but for B2C, it tends to be pretty good. So again, you just want to be careful with it. There are methods that you can use to account for some of the non-representative issues that I'm kind of alluding to, but in general, it's a very helpful data source. Obviously, a big part of this work is not only what the unit economics are now, but what they're going to be in the future. And so you want to be mindful of network effects, because network effects can lead to CAC moving down over time. Typically, CAC tends to move up over time. And the reason why is the customers that you acquire early on, you don't need to push so hard. But as the company grows and scales, you can only acquire a customer one time. And so the people who are jumping on the bandwagon late through those scalable paid acquisition channels, it can just be a little bit pricier to bring them in. So if you're if you're a business like Uber, Lyft, or Farfetch, or some other marketplace, just by virtue of growing and having a lot of people on the other side of the market can make it more attractive for new entrants and lead CAC to go down. Another thing to be mindful of is TAM, or the size of the applicable market. Peloton has had issues with this. So they have very good economics. Again, I was showing that chart of their net CAC before, or the text rather. And what we could see is their net CAC was really quite good. It was like almost zero. There were some years where they were getting paid to acquire customers. And then they have this stream of subscription revenue that comes at a very high margin that they have for a bunch of years into the future. But I think the big question with Peloton is how many people are they going to get to buy those expensive bikes? And if they start having to do things like cut the price on the bikes, or allow people to have the bikes, but just only charge a subscription fee, how's that going to erode the economics of the business? Contrast that to HelloFresh, which to their credit has been very good at acquiring a very large number of customers while not seeing their CAC move up. So again, we want to be very careful in how we think about not only the economics today, but how they evolve into the future. And things like network effects and TAM can affect that. So again, hopefully I've shown you this sort of information can be quite useful, especially for businesses that may not be profitable today, even on an adjusted EBITDA basis. So look for these measures. They're out there. Companies will disclose them. And you want to be careful about their definitions, but they have to disclose the definitions. And a lot of companies do disclose them either in a kosher way or in a way that you can very easily adjust them back into a kosher definition. You're going to want to look in SEC filings and investor presentations that are not necessarily audited, but typically tend to be accurate, and alternative data sources. There's the data that companies directly disclose, and then there's the ability to connect the dots with statistical models like the ones that I was alluding to. So you can do this triangulation game where you figure out what the retention curve is for a company that doesn't disclose the retention curve from everything else that they disclose. And that is something that I would definitely recommend doing. It's something that we do at Theta all the time. And you're going to want to get those economics, judge, how you think that the market size is going to allow them to continue to adopt while still maintaining CAC, or if CAC is going to move up, when it may stop growing, and just use that to understand what you think the economics are going to be in the future. So, hopefully this has been insightful. Again, we're kind of bringing together marketing and finance through statistics to help better forecast revenue and understand other related measures of path to profitability. Lots of companies disclose this data. Lots more we can infer either from what they have disclosed and alternative data sources. That's definitely worth doing. Just be careful with those definitions. Here's some additional resources. Again, I mentioned my LinkedIn. I also gab a lot on Twitter. So for those who are interested, D_McCarr. I've included some of the seminal work. I've included another paper about how we can more properly incorporate alternative data sources like credit card panel data into the sort of models that we talk about in an HBR article. So again, I put my email in the chat box. If you want a copy of the deck, just ask. I'd be happy to share this as well. So that's pretty much all I got. Yeah, thanks so much, and I welcome any other questions you might have.
Thank you, Dan and Tammy, and thanks to everyone who connected with us today. We really appreciate it. And look for an event survey to follow, including the replay of today's presentation and the slide deck. So with that, again, thanks so much, Dan. Have a good afternoon, everyone.
All righty, take care.
Bye-bye.
Bye.